Hello, my name is David Meek. Work for Benchmark Mortgage. I'm a mortgage advisor in Louisville, Kentucky, and I'm here today to break down the relationship between interest rate and purchasing power. Now, I want to start by saying that it's purely educational, and I hope you will find it beneficial and helpful to you. To get us started, I have a few slides prepared, and I think that we should start with explaining that there is a lot of times, especially for first-time home buyers, some misunderstanding related to total payment versus the principal and interest portion of the payment. So very often, if a person has found a property, let's say online somewhere, and they're interested in it, very often you will find a link on that same website to some sort of an online mortgage calculator. The calculators are very simple and they're accurate as far as being able to calculate the principal and interest repayment portion of the loan, given the scenario that people input into the calculator, but it very often does not account for things like insurance and taxes, and if the property is in a flood zone or has a homeowners association and those kinds of things. So I wanted to provide a breakdown of how that would look, just to account for all those other things. And then we'll get into some slides that I have prepared to show the relationship between interest rate and monthly payments, and then obviously how that would impact the purchasing power. Here we can see the first slide that I was talking about shows a breakdown of the monthly payment, or what I would call the mortgage payment structure. And then let me start by saying that this is an example of a $200,000 purchase price, assuming a 10% down payment, which translates to a $180,000 loan size. And this also assumes a 30-year 30-year fixed rate at 4% interest. With that as the foundation, let's break this payment down. So I'll start actually at the bottom. The total monthly payment is often referred to as the PITI payment, the PITI, because this acronym communicates that it also is accounting for, in addition to principal and interest, it's also accounting for taxes and insurance. And in most cases, a lot of loans, those are the only things that we're accounting for. Some loans, like in the example we see here, we also need to account for mortgage insurance, homeowners association dues, and flood insurance. Now, sometimes things like homeowners association dues are not actually collected as a part of the mortgage payment, but on our end, in the qualification part, we have to calculate this as a monthly figure and include it in the loan qualification debt to income analysis. To stay focused here, we have our principal and interest portion at the top. So in this example, given the terms that I've provided, the principal and interest portion of that payment would come out to around, I'm just going to round here out, say $860. And then in the part of the country where I live, which is Louisville, Kentucky, it's reasonable to assume for a property price, or property priced at $200,000, the taxes should be roughly $180 a month. Homeowners insurance, again, this is going to be dependent on the age of the home and some other factors related to the home itself. But it's reasonable to assume for a house in that price range, that homeowners insurance should be around $95 a month. Mortgage insurance, I'm assuming, is based on a price of 0.5%. And homeowners associations, it's just going to depend on the neighborhood, wherever the house is located, or if it's a condo or whatever the case is. Many homes, single-family residents in this area don't even have homeowners associations. So I don't want you to think that every home that you look at is going to have all of this included. This is just an example of what could be included and would need to be accounted for before you go on and start making an offer, which is what's so important that you connect with somebody like me in your area before you make an offer on a home. Make sure you've got your financing figured out. And then the last piece is if you had flood insurance requirement, which would be the case if the property were located within what's called a flood zone. And so these are just estimates for what they could look like. But the important thing, the reason I added all that in here is because this is a realistic example, in the sense that it's very possible that a person might find a $200,000 house in their area and think, oh, good, I can buy this house and my monthly payment's going to be $850, $859, $860, because their mortgage calculator that they found online only accounted for that part of the payment and failed to include estimates for these other parts that might also be required. And you can understand how that can be pretty disappointing for a person if they're thinking that they're going to make an offer on the house and get the payment, and it's going to be, we'll say here, under $1,000, which might be their monthly goal as far as what they can afford as a family. And then they find out that after all these other things are added, in reality, that payment's over $1,400, right? It's pretty disappointing. We want to avoid that if possible. So now that we have a good foundation for our mortgage payment structure, let's move into how buyer purchasing power is impacted by a change in the interest rate, which was the original question that we were here to answer in this video. So you can see our slide here on the left has a scale for rates from 2.75 up to 4.5, 4.25. And also at the bottom here, you see a range of loan amounts. But let's just start here at the first one. We'll go slow. And let's say that our interest rates in the current time we're watching this video, it's reasonable to assume the rate for the loan we're looking at is 2.75%. If this is the case, on a $100,000 loan, 2.75%, the principal and interest portion of the payment is going to come out to $408. So if the interest rate changed by, we'll say, 1/4%, moved up just to 3% from 2.75, then that same 408 principal and interest payment, it's not going to be exact, here we're at 411, but it's close to that. You'll notice that in order to achieve that same payment amount, very close, the loan amount size has dropped from 100,000 to 97,500, which is a 2.5% decline in purchasing power. If it goes up another 1/4%, another 2.5% decline, 5% total from the original starting point. And so that's the relationship. That's the answer to the question. So for every 1/4% increase or decrease in the interest rate, you should see roughly a 2.5% change in the purchasing power. For every 0.5% change, then it's a 5% change. 0.5% change in the interest rate, it's a 0.5% change in the purchasing power. So this is a pretty simple chart to follow. Hopefully that helps. Here's a little bit of a different way to look at the same information. Instead of looking at the loan amount on the bottom side here of the chart, now I've got it set up so that you're looking at the principal and interest portion of the payment and calculating what type of a loan amount that is. So if you said, okay, well, the going rates today are 3.5%, and I can afford $1,100 monthly payment, then that's going to be a $245,000 loan amount. All right, that's my purchasing power for that preferred payment at that going rate. And so if rates were to change from the time I made that determination and the time I'm actually moving forward with a purchase for whatever reason, sometimes things are delayed and markets shift from time to time. But let's say that the rate adjusted from 3.5 to 4.25. Well, if your target for payment was still $1,100, then your purchasing power would decline from $245 all the way to $223,600. Pretty significant change. But if you were like, well, gosh, I really wanted to stay over that $240 mark as far as purchasing power, well, you could, but at that higher interest rate, you would have to increase your monthly payment threshold by $100 from $1,100 to $1,200 in order to get close to that same $245 purchasing power. So hopefully that makes sense. Last slide I have for you is just to show you some of the ways you can connect with me online, whether that's Facebook or Instagram or LinkedIn or Twitter even. Not super active on Instagram and Twitter currently. I'm getting more active there, but I'm very, very active on both LinkedIn and Facebook and now on YouTube. So speaking of YouTube, I hope that's where you're watching this video right now. And if it's not, you can just type David Meek, Benchmark Mortgage in the YouTube search, and you'll be able to find my channel there. It would help tremendously if either while you're here now or if you'll do a quick search and find that, go on in and hit subscribe. I try to release new content on a weekly basis, and I really appreciate everybody's interest in the videos. If you have any comments or questions, or if there's anything you'd like me to record a video about, if you have a question about, I'd be happy to do that. I definitely do take requests. Whether you're in my area of the country or somewhere else, I want you to consider me as a resource for you and your family. And I really appreciate, like I said, you taking the time to watch this and help me spread the word. So God bless. Hope you have a great day, and I will talk to you again at some other point. Thanks. Bye.